gold and silver mining stocks, Bitcoin, it's gonna rock, it's gonna blast off. Just like it did. It's gonna look very similar to the way 2020 was.
Special coverage of the New Orleans Investment Conference is brought to you by Victoria Gold, leading Yukon's new gold rush.
Welcome back to SF Live here from the New Orleans Investment Conference special coverage. We are delighted to be media partners of this fantastic event. My name is Kai Hoffmann. I'm the @JRMining guy on Twitter and also the CEO of the Soar Financial Group. And we are joined now by Larry Lepard. Larry, it's fantastic to have you on the program.
It's great to be with you, Kai. It's nice to see you again. It's been a little while.
Long overdue that we're doing this.
Yeah, absolutely.
We saw each other only last September.
Yeah,
at one of our events at Beaver Creek.
Exactly.
It's great to have you here now.
Thanks. It's great to be here.
Yeah, it's a great conference. I'm really blown away by the quality of the speakers, yours included, and the quality of conversations we've been having.
Right.
And I was joking just now, I was like, this is my 10th interview today, so if I slur my words a little bit, but it's great to have you on. Let's talk a bit about the themes of the conference here and what you've picked up the last 24 hours here as well.
Sure. Well, as everybody knows, there's so much going on in the economy right now and in the markets as well, right? And so there's a lot of talk about the Fed actions, the Bank of England, et cetera, et cetera. And that was really the subject of my speech, which I'll just give a kind of brief overview of because some people may not have seen it. I think we're kind of at a very important inflection point where things are starting to break, and they're starting to break rapidly. We all know the fiat money system is broken, has been broken for a long time. The first breakage of it was notable breakage of it was 2008. Had a long interregnum where nothing really went wrong, and then of course we came up to the next one in 2020, in March of 2020, and COVID and that whole crisis erupted and created a huge, money printing extravaganza. And we're now reaping the harvest of what we sowed there, which is of course massive inflation. And as a result of that, we're seeing our bond markets start to really become discontinuous, and that's a problem. And this is all driven by the Fed actions, which they were extremely aggressive at not only raising rates as the fastest rate in history, but also tightening, selling assets off their balance sheet, quantitative tightening at 2x the rate they did it in 2018 and 19. And of course that blew up that tightening cycle, and they had to pivot there too. So I think what you find, the theme here, everyone's a little beaten up because our stuff hasn't really worked for the last 6 months or so, tad longer, but I think everybody is cautiously optimistic that if you look at how things are unfolding, this is a perfect setup for gold and silver and gold and silver miners. And in fact, that was a big theme of my speech, is that we're kind of lucky bastards because we don't feel like it right now, but we're sitting on a rocket ship that I believe is about to take off. And just to answer the timing question, that could be in a month, that could be I put the outside edge of it at 18 months. I think it's much likely that it'll be the next 3 to 6 months. So
let's talk a bit more about the fuel powering the rocket.
Yeah.
And what is lighting the fire under the rocket as well.
Yeah.
What do you expect as sort of one of the triggers?
Well, right. So that's a great point, and I mentioned this as well. I mean, we're kind of we're in a sovereign debt crisis. We're in kind of a debt doom loop, right? And a lot of people haven't thought it through in the markets, haven't thought it through and done the math, but some of us have, and I think the market is quote unquote doing the math. And by doing the math, I mean, interest rates are going up quickly. A couple of years ago, the U.S. federal deficit, U.S. federal budget had about $350 billion a year of interest expense. We're now running at a rate of $670 billion a year of interest expense. And we've got all this debt lined up in short maturities, which are going to roll quickly. And if you do the math, you've got $31 trillion of debt. Some of it's longer term, but most of it's short term. And take that up to 4%, and 4% of 3 is 1.2. And so what happens here is, the budget deficit is going to get blown out. And we're running a deficit of around $1 trillion this year, and that's distorted because we had $600 billion of tax income in April of this year that really was based upon the bull market that we had. The big bull market in stocks created a lot of capital gains. So we went $600 billion above trend line for taxable revenues in the U.S. federal government. That's not going to repeat because we don't have a bull market anymore. Market's gone down. So that's not there. Then you've got the student debt forgiveness.
Is that happening, actually?
I think it is, as far as I know.
We got like 3 weeks, what is it now, 4 weeks until the midterms.
Right, so you got that, and that could get worse if they decide to increase the amount. And then you've also got the increase in Social Security payments. There's an inflation adjustment on that. So, and of course you got rising interest expenses. What I'm describing, I think it's been described by others very well, is kind of a debt doom loop, which is your interest costs, you've got a lot of debt, your interest costs go up, therefore your deficit goes up because you don't have tax revenue to support the cost of the debt. the larger deficit means you've got to sell bonds to cover the deficit. You're selling those bonds into a market that's already saturated with bonds, and so what do bond buyers demand in order to buy them? They want a higher rate. So your rate goes up higher. Well, guess what? If your rate goes up higher and you sold more bonds, you're going to have a bigger deficit. and so it's a circular motion. It's a doom loop. It's a rinse, wash, repeat. And this is the kind of thing in the history we've seen in emerging countries. This doesn't happen to G7 countries, right?
Yeah.
But in this particular case, it has, right? I mean, we saw the Bank of England had very discontinuous 10-year gilt and Great British pound markets, as recently as a few weeks ago. And of course, they had to reverse their policies and come in with enormous buying. They said it was going to be temporary. They've already walked that back. It can't, now they said they had 3 days. Well, they've walked the 3 days back. I mean, the central banks, the central thesis, Kai, and you know this very well, but some of your listeners may not. The central thesis is these guys are trapped. The central banks are trapped. They have anything they're looking at doing leads to printing more money. Printing more money leads to more inflation, et cetera, and it's a circular loop. And what's surprising to me, is that the metals haven't figured this out yet. But the metals are still reacting to the fact that the dollar's extremely strong and interest rates are going up, and M2 is going down, and so the liquidity is being drained out of everything. I mean, as you can see, I showed a chart in my presentation. This is one of the largest drawdowns in asset values in history. It exceeds the drawdown of 2000. When the 2000 bubble burst, we went down a lot. When the 2008 bubble burst, we went down a lot. When March 2020 burst, we went down a lot. This is larger than all of those by a good measure. So it's a big deal. And so my contention is, things are breaking, and they're breaking now, and it's going to manifest itself in much higher metals prices as people come to see that these currencies are no good. I mean, the real issue, the thing that creates hyperinflation or high inflation is abandonment of the alternative. So the dollar has been the only alternative, or the leading alternative currency in the world for a long time. And people have ignored silver and gold because they trust the monetary authorities. That trust is being very rapidly dissipated. And more people are going to come to our stuff. And you're seeing that, right?
Yeah. So, of course, like gold and silver are monetary metals. You use that to protect and hedge. It works really well in other currencies right now. Obviously not in the US dollar because it's too strong.
Yeah.
But it really works well in the euro, even in the Australian dollar, Canadian dollar. We're at all-time high gold prices. But how do you break that vicious cycle? Like, that's the question. Like, sort of, what is the next step? You say things are breaking.
Yeah.
We got panelists here saying end the Fed, the US dollar is dead, digital currencies next July. I'm a pragmatic, right? So I'm looking at it as like, but what is realistic?
Yeah.
Right? A debt default? Are we going to default and then give up?
No. I mean, look, that's always, anything's a possibility. It's a very, it's a very emotional environment. It's a very volatile environment. But if you're a betting person, as we all have to kind of be, I think it's a fairly high probability bet that as the system starts to really feel pain, and we know what will happen if the U.S. bond market starts to fail, if the U.S. starts to look like England, and the bonds go no bid and interest rates go much higher, the Fed is going to have to change their policies and step in. And they'll have some new set of words for it. They'll have some new spin on it. They'll make it sound, Powell will imitate Bernanke and say, I have to do this to rescue the world.
Yeah.
Right?
Well, he just won a Nobel Peace Prize for it, or whatever
exactly.
it is.
And so suddenly, maybe at that time we'll have a few good inflation prints. Maybe we won't. Maybe they'll, but maybe they'll be able to fake some good inflation prints, and then they're going to say, all right, it's good. It's all good, and they'll go back to buying and printing. And when that occurs, the monetary metals and Bitcoin are just going to go to the moon. I mean, because again, as I said earlier, failure in these currencies occurs when everyone realizes they can never stop. And mathematically, they can never stop. That's the thing. I mean, some people say, well, this is all just your conjecture. And certainly the timing is conjecture, but the math is kind of relentless. I mean, the math is the math. I mean, we got to pay the interest. The debt's getting bigger. The interest is getting more expensive. Therefore, the deficit's going to blow out. I mean, it's like, how do you square this circle? I mean, I don't really see how you do it without printing money to pay off your debts. And okay, everyone says, well, that could be a disaster. It could lead to Weimar. Maybe not. But what it definitely will lead to, it has to lead to, is higher inflation. And so I think, I think we're very much in, as Tavi's presentation did a great job this morning of laying out, I think we're very much in an inflationary cycle like the 70s that's going to last a number of years, and that although there will be there will be impulses and retracements, and it'll go back and forth, the general trend will be more inflation. And I think when that's the case, the general trend in the precious metals would be higher because you can't print them. And oil too, by the way. I mean, all commodities I think will trend higher in the next 10 years. And hopefully we'll get through it without massive hyperinflation or massive deflation or a world war. I mean, look, inflation is bad, but it probably, a medium-high inflation rate where we inflate away the debt is probably a better choice than some of the extreme alternatives.
But
right?
even at 8% inflation, it'll take 40 years to inflate away the debt.
Well, that's a good point. That's a good point. But they might let it go higher than 8%. And by the way, they might at some point there might be a deflationary impulse where we get a print much lower than 8%. I mean, they have really, quote unquote, broken the money or broken the system. And I think this is the point of Brent Johnson's presentation is, I think all we can really plan for is we don't really know what's going to happen. There's going to be a lot of uncertainty. This is an extremely difficult time for investors. But I think it's a pretty easy time to sort through your investment alternatives. We know that bonds are probably likely to not do well, except maybe in small deflationary, counter trend moves. We know that the dollar, while it's getting stronger now, it will eventually weaken because of the balance sheet of the United States and the deficit of the United States. And we know that stocks are still overvalued, and so that stocks aren't really someplace you can hang out in. With perhaps the exception of stocks that have commodity-like characteristics. Again, I think the best analog to this is the 70s, and in the 70s, the two best performing stock categories were gold stocks and oil stocks, both commodities. And I feel like I think we're going to see $150 oil, $200 oil. I think we're going to see 2,000 plus gold. I think we're going to see $50 plus silver. All within the next couple of years. And as you know, and as I know, being in this industry, looking at the space, looking at how up and down and how much this swings because of all the volatility, if those kind of numbers occur, some of these companies that we've invested in are just silly cheap.
Yeah.
I have companies in my portfolio that are trading at 3 times cash flow. 3 times, that's a 33% implied yield. And these are cash flows where they're growing their production, and I think over time, the metals prices will make their cash flow double. So, there really are literally 2 to 10 baggers laying around in this space, but, it's a scary space. It's volatile, and I'm on a drawdown this year that's substantial. So you can't, if you want to swing for the fences like that, you're going to have volatile times.
I was going to ask you, how's your fund, sort of composition? How is it put together?
Yeah, it's a great question.
Because you mentioned the high risk stocks. I'm sure you can't be 100% in the highest. The juniors over there.
No. And I will say this again to all your listeners. Look, there's plenty of alpha and upside in some of the big names. This is one of the places where you can actually buy big, high-quality names and have a chance of getting 2, 3, 4 baggers. Agnico. I love Agnico, right?
Yeah.
There are other Alamos. I like Alamos a lot. I like.
We've been talking Barrick earlier, Newmont, 5% dividend yield.
They're not bad. The challenge of those two is they're just so big they have a hard time replacing what they mine. But yes, there are many others. They're growing ones like Equinox. There are deep value companies like Silvercorp, and everyone hates it because it's in China. But, I don't think we'll get into a shooting war with China. I could be wrong about that. But, all the same, I'm buying it at 1.5 times cash flow. So this is really cheap stuff. So, basically to answer your question about portfolio, I'm about 50% producers. So, look, the mining business, in my opinion, is a very tough business. You're breaking rocks and you got to replace what you mine. So those two things, and so Murphy's Law applies, as you know. No. And you can have the best team in the world, you can have a great deposit, you can still mess it up because people do it all, we've seen it, they do it all the time.
Every day.
Every day. So you got to have a lot of these because the ones that make you 10x have to make up for the ones that go to 0. And there are some of those. That's that's a fact.
Yeah.
But if you have a company that has positive cash flow, your odds of going to 0 have automatically been taken down because they don't need to access the capital markets to raise money. And so that's a big bucket that we have a lot of our money in, and we like that the best. We like those that are then going to grow their production. That's like a twofer because then you've got an existing cash flow stream, but you got growth. So that's kind of a growth value, right? But then, of course, if you want to be a little more aggressive, you get into the developers. Big risk there is CapEx. We've had some big CapEx overruns.
Inflation blowouts.
Inflation blowouts, Argonaut, IM Gold, etc. And then, of course, the real sizzle and also the real risk and downside is the drill stories. And as you find a snow line and you hit great stuff and suddenly you're up 10, 20x instantly. Yeah. And on the other hand, there are a lot that don't work. So, we probably have, as I say, 50% in the big producers, maybe 15% in the developers. We're very selective there. It's a risky business, and then maybe 15, 20% in the drill stories. And then we actually believe in Bitcoin, which I know it's not part of this conference because it's more.
You're the first one to bring it up, actually.
Yeah, it's more a gold conference, but I actually believe Bitcoin is an emerging form of sound money. Very early days. But I think the ledger is immutable, and therefore I think Bitcoin will ultimately be seen as digital gold. I think there's an enormous optionality in it. There's also enormous volatility in it. We only have maybe 15% of the portfolio in it. And the reason, and that's a mixture of companies and the coins themselves. And the reason for that is, it can draw down 70%. Having said that, right now it's on one of those drawdowns and it's at $20,000 roughly. I mean, in the next run-up, I expect Bitcoin to go through $100,000, $150,000 pretty easily, maybe 2 years from now. Yeah. But the thing that's compelling there is, and I've now gotten comfortable with the technology, is the risk on the technology is quite low. The thing that's compelling there is there's a fixed supply, and adoption continues to grow. I mean, hash rate, addresses, usage, the Lightning Network. So think about it. If more and more people are using Bitcoin and there's a fixed amount of Bitcoin in the world, what's going to happen to the price? There's only one way it can go. Yeah. It's going higher, right? So
to sort of wrap up the conversation, what do you expect in the next 3 months? Like really a short term now.
Yeah,
I think long term we agree. Yeah, we're in the right industry.
So I'm out on a limb here a little bit, and I'll probably be wrong. Okay, but I think it's game on right now, Kai. I really do. I think this Bank of England thing is a big deal. And I think, the Italian bonds have been, all the bond markets in the world are looking really, really broken. And I think these bond markets, these bond holders are saying, hey, hang on a second, you're paying me 4% and inflation's 8%? No. I'm not doing that. I'm losing money every year. I'm selling this bond. Well, when they sell that bond, that's less demand for money. So the 4% goes to 5%. Right? And of course, then some government has to pay the 5% and their deficit gets bigger. So I guess the point is, I think the bond market, in the next 3 months, I think worldwide the bond markets are going to force governments to go back to massive money printing. And I think when the market becomes aware of that the hard money stuff, which I call gold and silver mining stocks, Bitcoin, it's going to rock, it's going to blast off. Just like it did. It's going to look very similar to the way 2020 was, And that's the tough thing about this business. You get these periods where it's just insane and it just goes crazy on the upside and everybody's chasing it. Nobody's being discriminating, right? And then you kind of peak out and it dribbles away and then we'll have another correction, right? Yeah. And that's kind of the nature of the business. But I actually think that will happen within 3 months because of the condition of the bond markets.
Interesting. Really interesting commentary, Larry. Where can we find more of you? I know you're active on Twitter.
Yeah, I make a lot of noise on Twitter. Well, I don't like the central banks very much. I think what they've done is really wrong. But let me set that aside. Active on Twitter, just my name, @Lawrence Lepard. And then I have a website for my firm and my fund, and Manage Money. And that is EMA2, Edward Mark Alpha, the number 2. The name of the company is Equity Management Associates. Just Google it, you'll find me.
Awesome, Larry.
Thank you, Kai. Really
thank you so much for coming on. Really appreciate it. Great conversation.
Thanks.
And you're coming to Frankfurt.
Yeah, I'm coming to Frankfurt.
Fantastic. All right, you heard it, recorded it.
Yeah.
Thank you so much for tuning in.
Take
SF
care.
Live on site from the New Orleans Investment Conference. Follow us on YouTube, follow us on Twitter. Hit that like and subscribe button. Leave a comment. What do you think is going to happen? And we'll be back with lots more very soon here.